Hi, this is Doug English with Active Advisors, here to talk to you about legacy planning. In thinking about the way folks leave assets to the next generation or leave assets to a charity, you can take advantage of the tax rules to be able to get more money to everybody, to your family, as well as to the charities that mean something to you. So what many folks do is they leave the same percentage all the way across all of their accounts. So their bank accounts, maybe 25% to the church and 75% to the kids, in their IRA account and their cars and their house and everything. When you do it that way, you're not benefiting from the difference in strategy. See, the IRA or 401k or annuities, all of those things that have a tax liability in them are much better to leave to the church because those assets have no tax when the church receives them, but if you leave them to your family, of course, they're going to pay their effective income tax rate. So the strategy you want to use is tax-free assets that receive a step up in basis, like any after-tax investment, how real estate, businesses, cars, antiques, collectibles, anything that does not have a tax liability built up in it is the best thing to leave to your family. Things like IRAs, 401ks, 403bs, tax-deferred annuities are the best assets to leave to the church because the church does not have to pay that untaxed liability that your kids would have to pay. And you can sort of figure out how that works as you kind of spreadsheet it out and say if you leave more of these tax-deferred assets to the church and less to the kids may still end up with the same amount of money because of the impact of the tax-deferred assets going to the church. And of course, if you have an effective tax rate of 30% or something, that's a huge amount of leverage from letting those tax-deferred assets go to your church.